Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 82 on October 5th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on PG&E, ArcelorMittal, and Bausch Health Company, and we discuss three new trades on GameStop, the Invesco QQQ Trust ETF, and the Walt Disney Company. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can email questions to eric@theweeklyoption. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets rallied the last couple of days to keep us from closing on the lows of the week, which were significantly lower. The Dow Jones Industrial Average closed 246 points lower, ending the week at 26,573 points. The S&P 500 index dropped 9 points week over week, really closer to 10 points, finishing at 2,952 points. Now, each week I discuss a different topic pertaining to trading options in our topic of the week. The topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. Now, the topic this week is protecting your stock portfolio. So there's a lot of news out there right now, and we're seeing more volatility in the market about the possibility of us heading lower, even the possibility of recession. There have been questions about recession and the possibility of a downturn in the overall economy. So what do you do? How do you protect your portfolio? Well, you can certainly use several different option strategies to protect your portfolio of stock, or maybe you have a 401k and that sort of thing. But I just want to discuss a handful of strategies that are used both by me, by asset managers, by all sorts of people who trade their own positions to protect their stock portfolio. So first position or first strategy is buying puts. Now, the good thing about buying puts, this is essentially insurance for your portfolio. So for every 100 shares of stock that you own, if you own a put option against it, then as the stock price goes lower, the value of that put option gets more valuable. So as the stock market goes lower, you are protecting your portfolio because you have another asset that increases in value when the stock price goes lower. The downside, of course, to buying puts is that you're paying money today for this future event that may not happen during the time frame that you've bought. So let's say you bought options on November, put options for November to protect your portfolio, and the stock market actually drops in December. Not only has your insurance expired, but you paid money up front for that insurance, and so it's really just an economic loss to you. So there are ways to hedge that. You could buy longer term puts. They obviously will cost more money. There are all sorts of things that you can do, but that's one of the ways to protect your portfolio if the market goes lower. Now, as strange as it's going to be for me to say this right off the bat, another option that you have is actually selling puts. And this is just a little bit different because selling puts can be yield enhancement, and it also can be a way of buying shares of stock at a discount. So what happens is if the market holds where it is or goes higher, then that money that you receive for selling those puts really is just additional premium. It's yield enhancement, meaning it's money that goes into your account that didn't end up costing you anymore. So you're selling put options which means you receive money today. If those options never end up in the money, which means the market didn't go down, then all that happens is you keep the money and you can sell more puts next month or whatever your time frame would be. Now, if the market goes lower, when you sell that put option, once that option is in the money, you will be buying stock at a lower price. So if you sell put options, make sure it's at a price that you wouldn't mind owning stock. So if you look at Apple shares and you're like, I'd love to buy it 10% below market, well, why don't you try selling puts 10% below the market? And if they're ever triggered, you're going to be buying your stock there. Now, the kicker there, of course, is that you're buying at a time when the market overall is going lower. So as long as you have a long-term sort of investment strategy or investment time frame, it's okay. If buying those shares as the market gets lower is going to freak you out or really go a little bit beyond your current risk tolerance, I would advise that you stay away from selling puts because you will be buying shares at a lower price. And there's some margin issues too we'll come up on in a minute. The other option that you can do to protect your portfolio, and it gets a little harder as the market's going lower, of course, but that's to sell calls. Now, this is the covered call strategy because I mean selling calls against stock that you already own. So as the stock goes higher, it's nothing more than yield enhancement. Of course, if you sell them 10% out of the money and they end up being in the money, if those options end up being in the money, what ends up happening is you essentially were paid money to sell your stock at a higher price. Now, people get all distraught about this. There are a number of things you can do before you have to turn over your shares. You can buy more shares to fulfill that options obligation. You can just go ahead and buy the option back and close the trade. I mean, you will have made money on your stock price going higher, and it gives you a chance to just keep that stock in your portfolio longer, or you allow the rise in the stock market to take you out of the position. When the stock price goes lower, what you've done is you've created a little bit of cushion to protect against those losses. So if I sell that call option for 50 cents and the stock price goes 30 cents lower, it's okay because I actually have a 50-cent cushion as far as a real dollar for dollar amount. I have a 50-cent cushion on the stock price. But if it goes lower than that 50 cents, then obviously I'll need to do something else. Like if you've listened to the show for a while, you've seen me roll the strike lower on covered calls. So hopefully you understand how that's done. But those are just a few ideas on how to protect your stock portfolio using options as the market goes lower. And there are margin requirements that might supersede your ability to put these positions on. So when you sell a put option, you have to have margin to be able to buy 100 shares of the stock at that strike price. So let's say stock is trading for $12 per share and I sell a 10 strike put option. The margin on that, I'm going to collect money when I sell the option, but the margin on that put option for every 100 is going to be $10, which is the strike, $10 times 100 shares. So it's going to be $1,000 of margin. So you have to have the margin to be able to buy the stock in case that put option goes in the money and you actually have to buy stock for $10 a share. Selling calls against stock that you already own is always possible as long as you're selling one option for every 100 shares you own. If you end up deciding to sell calls on a stock that you don't own, or let's say you have 1,000 shares, which would be 10 options, but you decide to sell 20 options instead, now you are naked on 10 options. You're going to need not every brokerage house will allow you to do that depending on the size of your account. Some require at least $100,000 in your account. So the way around that, and this would also work for the short puts, is to actually use spreads. So back to our put example, if we decided to sell the $10 put and then buy the $8 strike put below it, now we only have $2 worth of risk. that's $2 times 100 shares of stock. So that's only $200 rather than the full $1,000 that you would have needed to be able to offset the risk of just selling the put by itself. The same thing applies with selling calls. If you wanted to go beyond the stock equivalent number of shares that you own, one of the options that you have is simply to buy an out of the money. So you sell the closer to the money call option, and then you buy an out of the money call option, so that now you don't have to have the larger account. You just have to be able to afford the risk that's inherent in the spread, which is going to be the difference between the strikes. So that's it for this week's topic of the week. I don't want to go too deep, but definitely, once again, if you understand options, you just have so many more ways to make money in the stock market, and that's the whole point of our investment strategies, right? So if you want to learn a little bit more about options, definitely check out the video at theoptionstudio.com. I'm going to be making some changes to that soon as well, but that is a course that I created for the company, and it's great. I've had some great reviews and great feedback. Many of the students from that class listen to me every week on this show because it's just additional examples of how they can use the knowledge that they've learned. And we go far beyond, just what we talk about on the show. So that's it. Let's dive into the results from last week. And I'm a little happier this week from this week's trades than last week, because last week's show, I pretty much lost money across the board. And this week, it's going to be the opposite. So it tends to be a shorter show when I make money on every trade, but I don't think you guys mind. So that's it. Let's dive in with the covered call. We did a covered call on PG&E Corporation, symbol PCG, Papa Charlie Golf. The stock at the time was trading for $10.12 per share. I looked at buying that stock and selling the October 10-half call at $1, which creates a possible return of 13.64% in 4 weeks. Now, shares of PG&E rose 75 cents this week, closing at $10.87 per share. The October 10-half call we sold rose 40 cents in value and is now in the money by 37 cents. So that's great. At this level, the call option is in the money, and we're in the price range to collect our full return of 13.64% for this trade. Now, that's only if you hold the trade to expiration. If you were to sell the stock and buy back that call option that you sold, you would only net 35 cents for the trade. So that's not bad. You'll never go broke, making a profit. But at the end of the day, it's best to wait for this option to be exercised so that you're able to collect the full return, that full 13.64% that we hope for when we planned the trade. And then our second trade last week was a credit spread on ArcelorMittal, symbol MT, Mike Tango. The stock at the time was trading for $14.16, and I looked at selling the October 14-half 15 call spread at 16 cents, which creates a maximum possible loss of 34 cents per spread. Now, shares of ArcelorMittal fell $1.14 this week, closing on Friday at $13.02. The out-of-the-money call spread we sold is even further out of the money. So the spread could be bought back right now for a gain of roughly 9 cents per spread. However, because we're so far from our break-even price, I wouldn't even look at buying this spread back in. If we close in this price range in 3 weeks, or obviously lower, this spread is going to expire worthless, and we get to keep the full 16 cents premium that we collected for selling the spread. So I certainly will do nothing at this point. I'll only do something if I have a fear that stock prices are going to rise higher than $14.50, which is the value, the strike on our short call. Now, our third trade from last week, another win, is going to be on Bausch Health Company, symbol BHC, Bravo Hotel Charlie. At the time, the stock was trading for $21.70. We looked at buying the October 22-half 22 put spread, paying 33 cents for the spread, and that creates a maximum possible gain of 17 cents or 51% return in 4 weeks. Bausch Health Company shares fell $2.60 this week, closing at $19.10 per share. The in-the-money put spread we bought is even more in the money now. So we could exit the spread right now, and you would actually lose 3 cents if you just straight up crossed the bid-ask spread. So if you decided to exit the spread, you would definitely want to put out a limit order somewhat in the middle of the values so that you could actually lock in some semblance of some bit of a profit. But there's no reason to close this spread right now. As long as share prices are less than $22 per share in 3 weeks, we'll collect our full maximum gain of 17 cents, which is 51.5% return in 3 weeks. So again, that's a nice trade, and it's great to make a profit, but the goal is to get in the habit of taking the maximum profit. And in options, typically that means waiting until expiration in order to capture the full value of the spread. Now, let's say a week before expiration, we end up gaining, if we can close this trade and actually capture 15 out of the 17 cents, sometimes it's worth taking the money off the table. But at the end of the day, I like gaining or keeping all of my gains. It's the only way to really, truly get ahead. There are, of course, times when it's best to exit early. So that's it for last week's trades. Hopefully you guys are happy with 3 for 3 returns, anyone who decided to put these on. And if you have any questions about last week's trades, definitely send me an email. And I gave my email earlier, but it's eric@theweeklyoption.com. Now let's dive into this week's trades. And of course, we have 3 more weeks left in October. This week, we're going to stick with the October expiration. Hopefully, we'll be able to have some October expiration next week as well. But pretty soon, we're going to start looking at November trades. So that's it. We're going to start the week off the same way we do every week with a covered call. This week, I'm looking at a stock that is significantly beaten up. And I would really only look to put this on as a short-term covered call play to try and capture this gain. So I'm looking at GameStop, Class A, symbol GME, Golf Mike Echo. Stock ended the week at $5.55 per share. And I'm looking at buying that stock and selling the October 6th call at 15 cents. So between the stock gain and the call option, that the premium I'm collecting, that creates a maximum possible return of 10.81% in 3 weeks. Now you enter this trade by buying GameStop shares for $5.55 per share and concurrently selling the October 6th call at 15 cents. This trade makes the most money if stock prices finish above $6 per share, and the break-even price is $5.40 per share. Now our next trade is going to be a credit spread on the Invesco QQQ Trust. This is the triple Q ETF that mimics the movement of the NASDAQ. The stock symbol is QQQ, Quebec, Quebec, Quebec. The stock ended the week at $188.81 per share. And I'm looking at selling the October 191.191.5 call spread at 20 cents, which can create a maximum possible loss of 30 cents per spread. Now you enter this trade by selling the October 191 call at $1.55 and concurrently buying the October 191 half call for $1.35. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $191 per share. And I like this trade because we are more than $2 away from $2 out of the money right now, and hopefully we'll stay that way or maybe be even more out of the money. The break-even price on this trade, of course, is $191.20. And then our final trade on the week is a debit spread. We're looking at the Walt Disney Company, symbol DIS, Delta India Sierra. Stock ended the week at $130.27. And I'm looking at buying the 131 put spread for 63 cents, which can yield a maximum gain of 37 cents or 58.73% return in 3 weeks. So you enter this trade by buying the October 132 put for $2.85 and concurrently selling the October 131 put at $2.22. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $131 per share. The break-even price on this trade is $131.37. So that's it for the trades on this week. Hopefully we'll have another 3 for 3 win next week. But most importantly, I hope you guys are learning and following along with me, and maybe paper trading or even deciding to find some trades to put on for yourself. So I'm a firm believer of in option trading, kind of an option trading advocate, if you will. It's done great wonders for me in my career, and I think you would benefit the same by having this knowledge. So thanks for listening. If you have friends that like option trading and probably could use a little bit more knowledge, definitely share my podcast with them. I always love that. We're growing in numbers of weekly listens, which is fantastic. And if you have any questions, definitely reach out to me. My email, of course, is eric@theweeklyoption.com. We also have a Facebook page, a Twitter account, and we create videos out of this podcast. So if you ever want to listen via YouTube, you can do that as well. So thanks so much. Hope you guys have a great week and a great weekend. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.